Hello and welcome. You're watching Business Today. I'm Neetu Chandra Sharma, and this is Earnings Special. Lupin has reported its latest quarterly results with growth in revenues and margins. The company is also moving towards a more complex product mix across its key markets. To discuss the performance, capital allocation, priorities, and the outlook ahead, I'm joined by Ramesh Swaminathan, Executive Director and CFO at Lupin. Ramesh, thank you so much for joining us and taking the time out. Pleasure to have you on the program. I would like to start off by asking you that this quarter saw revenue growth and margin expansion. So, what were the key drivers behind this performance?
It's in line with our performance over the last 13 to 14 quarters, I would say. So every quarter has actually seen a successive increase in terms of EBITDA margins and the like. This has obviously come about in terms of secular growth across various geographies, and clearly, reflecting on the kind of pipeline that we brought to each of these geographies. Speaking about America, we have had pretty good performance coming in from molecules like tolvaptan, mirabegron, and continued good performance of Spiriva, not to speak of albuterol, and a few of the molecules that we launched in the course of this year itself. Likewise, if you look at Europe, it's come at the back of products like Nemuscla, Lufobec, and the like that we Raltegravir that we launched during the course of the last couple of years, and it continues to do pretty well. Emerging markets, for example, we've done pretty well in Brazil, where we actually brought in good products like dapagliflozin and the like. And of course, India always continues to do pretty well. We have never lost our sight, in terms of focus on India. It's always done very well consistently. This particular quarter, we looked at 10.9% for the Indian markets and the like. Clearly, the top line buoyancy is extremely important. Not to say that we have lost sight of the cost. The costs have also, there's been tremendous focus there. And that's why you see a lot of the gross margin increase happening over time, coming in both from top line as well as, in fact, the focus on cost, variable costs, input costs, alternate vendor development strategies, and the like. And clearly, that is continuing in every line across the P&L, resulting in a continuous increase of the EBITDA margin, so to speak.
Okay, give us a sense that how much of this improvement would you describe as structural versus product specific or cyclical?
That's a good question. So it's actually a combination of both. So essentially, we are in the business of generics, and generics is all about a good upside on launch, and then thereafter continuous downside. So from that perspective, it's important, at least in the US markets, that it's a bit like running on the treadmill. So continuous replenishment by way of new products is important. And that we've been successful in doing over the last several quarters. And that's why you find continuous increase in America. For example, this particular quarter, our overall turnover in America was close to $350 million, up from $315 million last quarter and the like, and so on. So clearly, top line buoyancy has got everything to do with, in fact, a good chunk of good performance. It contributes heavily. The other part, of course, is essentially productivity increase across every front. I just spoke about the fact that we work on alternate vendor development strategies, routes to synthesis, and a host of other things which help in bringing the overall margins, the gross margins up. Equally, focusing on productivity of sales force, productivity of the R&D, productivity of the marketing, the manufacturing. All of this has resulted in tremendous reining in of costs, eventually flowing to the bottom line.
All right. So what we have seen is that margins have strengthened meaningfully. So should investors view this as a new base, or could there be some more normalization ahead?
Clearly, this is a result of, in fact, exceptional circumstances with mirabegron. Though, of course, you heard about the fact that we just entered into a settlement to give us certainty in the marketplace, which will continue till September 27, so to speak. Tolvaptan, of course, there has been no competition as of now, but it doesn't mean that there will be no competition in the future. There could be. That's the nature of this beast in terms of generics. At some point, there would be competition and prices would erode. So clearly, providing for that, I would expect a slight dip in margins. This year, if I do close at anywhere between 27-28%, I would think next year target would be between 24 to 25%, given all of these. But clearly, we have done what we wanted to do in terms of bringing the core EBITDA to the levels of what I just spoke about.
Let me ask you about the US business that delivered a good growth this time around. So, what gives you that confidence about sustaining performance in a very competitive generics environment that we are seeing in the US business?
The fact of the matter is that we actually envisioned, us ourselves, with bringing down the overall salience of the more competed for OSD space. So we kind of pivoted to more complex stuff, the injectable space, the respiratory space, and of course the biologics, biosimilar space. Clearly, we have built up a huge pipeline for the future going ahead, especially when it comes to respiratory, with virtually every product worth its salt being launched by us over time. Equally, very, very impressive cashier products with complex injectables. We have a specialized platform in terms of Nanomi. So the proof of the pudding is Risperdal Consta that we have got an approval for. And going forward, it could be biosimilars. The overall regulatory framework for biosimilars, is quite favorable at this stage. And there are very few competitors, both from India or for that matter internationally. And we believe that we are very well set to position to kind of take advantage of this.
So, having said that, I would like to ask you that how does that change the financial profile of the business? Because Lupin is moving towards more of the complex, portfolio. How does that change the profile?
Clearly, with generics, you generally associate price erosion in America. So if you're actually into more complex stuff, the intensity of competition is going to be lower, and from that perspective, you are less prone to price erosion. But more importantly, I think the long-term intentions of the company is to move towards specialty. Clearly, I set our eyes, in that direction, and Namuscla in Europe, is a good example. We also have products like Zaxine in Canada, Zopinex in America, and the like. But more importantly, we've just bought into Visupharma, which is really into the ophthalmology space. So clearly, we believe that that's going to be a pretty important area for us. We've had some good experience with, in fact, respiratory generics, and we believe that going forward, we should really focus on products in respiratory, in the rare diseases, in the ophthalmic space when it comes to specialty as well.
So, also give us a sense about the R&D part of it. So, it remains a significant investment area for you. So, how do you balance pipeline ambition with return discipline that's going forward?
Clearly, that's always been a challenge, right? So we generally spend about 7.5 to 8% of our total sales on on R&D, and more importantly, kind of pivoting to more complex stuff out there. That as in given the fact that the turnover is increasing, that 8% in absolute terms also translates to a much higher absolute number. You know, but we have also done a couple of things which I think are very different from the rest of the peer group. In that, when it comes to more difficult, of that matter, very risky molecules, we kind of partner with passive funds, whereby the entire risk of development is actually taken away from us, whilst we share in the proceeds once the product is launched. So it gives us a leeway to look at pretty difficult products, more complex products as well. And that has served us in pretty good stead. And that is something that we would like to take to a higher level, given the complexities associated with a number of products going forward.
So, tell us beyond the top line growth, where are you seeing the most meaningful efficiency gains across the organization?
Oh, it's across actually. We've done a tremendous job in terms of manufacturing efficiencies. We've had a program running for the last 5 to 6 years, where we have worked with top consultants to deliver on tremendous returns, from a manufacturing savings, from a manufacturing cost perspective on the procurement front and the like. So clearly, supply chain has been one area that we have had a lot of focus on. Equally, we have actually looked at productivity on the R&D front, and on the sales front. So our productivity at the India region, for example, is amongst the best in the industry. Increasingly, we are also looking at AI-led use cases to kind of perk up productivity and efficiency gains across the entire spectrum of activities, the entire value chain, so to speak.
So, with a stronger balance sheet today, how are you thinking about the capital allocation going forward in the next few quarters?
That's a good question to ask. From our perspective, we have really clearly defined what should be our capital allocation policy. It defines the threshold of, the overall debt that we would carry in our books. That would potentially be twice the EBITDA. That gives us leeway to raise about $1.5 billion, I would say, or perhaps a little more. Equally, I would also say that we have clearly drawn the thresholds across various businesses. As the case of, for example, adjacencies, it's going to be exactly what we had envisaged at the time of drawing up the initial plans. So that will be the overall exposure limit, so to speak. India, we would be looking at assets between $250 to $300 million. And India is number one when it comes to overall investment philosophy. But the rest of it would potentially go in for specialty. There, I think we would perhaps be looking at larger assets, anywhere in the range of $750, $800 million over time again. And again, with all the return parameters, that we have set for ourselves intact, and clearly within the horizon of returns as well. So all of those would be important parts of our overall strategy.
So, in the current, tough environment in the generics business and environment for the pharmaceutical industry as a whole, have you identified any financial risks going forward?
Oh, there's always risk, as in the case of, for example, the dollar, so though, of course, it benefits us at this stage, given the fact that, rupee depreciation means better realizations from our perspective. But clearly, our exposure is to across various other geographies, including Europe and emerging markets and the like. Some of these actually move contrary to the movement between the rupee and the dollar. So, for example, the euro is appreciated, which is also good for us. But it also means, it's better translation, benefits for us in some ways. The emerging markets, of course, is a risk in terms of potentially, a constantly depreciating currency when it comes to some of these emerging markets like South Africa, Brazil, Mexico, Philippines, and the like.
So, from your perspective, I want to understand, is this a cyclical recovery or the beginning of probably a structurally stronger earnings phase for your company?
I think it's clearly structural, and that's the way it was for the last 3 years. We reached an nadir of about 10.5 percentage points of EBITDA margins just about 3.5 years ago, and since then it's been a continuous upside. So it clearly comes out from well laid out strategies in terms of crafting the pipeline as well as looking at strategies for reducing costs. So it's nothing but structural, so to speak.
All right. So the recent performance reflects changes in the product mix, cost discipline,
For
and
sure.
market position. The focus now will be on sustaining margins while managing risks across key geographies. Ramesh Swaminathan, thank you so much for speaking with us and sharing those perspectives. Appreciate your time.
My pleasure, as ever. Thank you.